So welcome to today's presentation on how to get 20% dividend per year. And I'm Eric, portfolio manager, CPA, and this is also my daughter, 6 months old. So let's get started.
So our mission is to help people retire predictably. This is a financial education startup and also an AI-powered investing fund. So I'm very excited because I got a couple of interesting things to show you. So 79% of Americans agree that there's a retirement crisis. And this is from the National Institute on Retirement Security in 2024. And here you will see a graph of the Social Security Trust Fund will be depleted by 2034. So in the next 10 years, there will be a reduction of Social Security by 23%. Retirement is becoming increasingly difficult, and people are already looking for solutions. We're solving a painful problem for our audience, and we mainly help people who are 45 to 65 years old without a financial background, for example, engineers, doctors, nurses, programmers, and they have an investing account of somewhere between $50,000 to $1 million. Now, traditional finance say that you need to save $1 million and get 4% withdrawal a year, so $40K a year, and you need to work for 45 years. Now, this is very capital intensive, and most people don't save and invest early enough to achieve that goal. So instead, with Investing Accelerator, we want to focus on saving just to get to 300K and use more advanced investing strategies to get 100K a year, so then they can retire sooner and also replace their income. And that's really where Investing Accelerator comes in. So there are two parts to our business, the education and the fund. For the education program, that's where you will learn how to do it yourself and learn the advanced investing strategies. The target is 20 to 30% return a year. For the AI mutual fund, that's where we invest for you using an artificial intelligence strategy. And the target is 20% net of all fees. And here on the left, you see the course page where you can go through the individual lessons and market updates. And on the right-hand side, that is the output of the AI investing strategy, which I'll dive deeper in this presentation. So for the education side, we're really helping our students achieve financial freedom. This is already a profitable business, and we have helped over 550 students. For example, Flo, here she made 45% in 2024, and she's a lawyer in Australia. Edward made 50% in 2023. Anthony made 61% in the last 12 months. So after we raise our first round of angel funding, we focus on scaling the education business to help more people. The tuition revenue has increased by 50% in September and 188% in October. And historically, a lot of people want to learn investing in the beginning of the year because that's when people are motivated to set new goals for themselves, go work out, and go learn investing. And usually for September and October, these are slower months. So last year, the revenue was $28,000 and $25,000 for tuition sign-on. And in 2024, it's $42,000 and $72,000. So on the right-hand side here, you'll see that our lead flow, which is the number of people who are signing up to watch the free presentation we offer, jumped significantly once we start scaling our funnel. We have been running this funnel every day for the last 5 years. And we spent $1.2 million in advertisement in total, and we get $2.5 million back in revenue. There's a consistent return on the funnel, which is around 1.5 times to 2 times for the last 5 years. So we have proven this funnel over 5 years and more. And the target return using this funnel is 50% to 100%. So below, you'll see a screenshot from the Google advertisement account. And here you can see that I spend 1.2 million here in ads. And this leads to 50 million impressions, which means people have seen our ads, which leads to 500,000 clicks. And that leads to 22,000 leads. So that is an example of how we're using data-driven approaches A/B testing for our advertising decision. So in terms of expansion, we're looking to offer mutual fund and hedge fund in the next 2-3 years. So this is what the final structure will look like. And we want to help people retire predictably. That's our mission. So on the upper left corner, you'll see the Canadian Trust. And that is the mutual fund that will allow Canadian retirement accounts to invest in. So our target is to raise 50 million here, and that will be helping 500 people to get 20% return. And on the right-hand side, we have the US private fund, and our target is to raise 100 million there. And there is a limit for now for 100 people, and this allows us to also help self-directed retirement accounts in USA to achieve 20% return as well. So they will be getting a 20.5% dividend minus a 0.5% management fee, and then they get a net return of 20%. And then the equity investments will be done through a limited partnership at the bottom. So on the left-hand side, that's where you get all the intellectual property in Investing Accelerator, the financial education program, and also the residual equity units. So the early investors today into this business will also get 20% return from the parent company as well. So let me talk about the AI and how it gets 20% per year. We mainly focus on avoiding bearish periods. So I have a data science and a machine learning background, and basically using my CPA portfolio manager experience, I feed the data to the AI, and it looks for pattern using the data I provided, and then it produces a signal on whether or not you should buy or hold cash. And then I'll review it and approve the decision before using any live capital. So in this diagram, blue means the AI will be buying and holding, and red means the AI will be holding cash. So during the bearish year in 2022, S&P 500 was down 19%, and AI is only down 8%. So we're able to avoid around half of the bear market, which is crucial to getting this higher return of 20%. And here is the equity curve using the historical data. So the AI is getting 20% per year, sometimes more. And for S&P 500, it's only 13% a year. So in 2024, we're using live capital within the corporation for this strategy as well. And we got over 20%. Now, in terms of portfolio metrics, this is mainly to calculate the reward versus the risk you take. So for example, the return for S&P 500 is 13%. And based on the amount of risk, which is the fluctuation, the Sharpe ratio measures the risk to reward. For the technology index fund, it's 14% return, and the Sharpe ratio is 1.75 because it's a little bit more volatile. And then there's also a 2x leverage version of the technology index fund, which gives you 18%, but then it is way more volatile. So then you can see the Sharpe ratio is actually going down to 1.3. So for every 1 unit of risk, you're getting 1.3 back. Now for the AI, it's getting you 20%, which is actually 2% better than a 2x leverage index funds and significantly better than S&P 500. It is a little bit more volatile than S&P 500, but then in terms of your risk to reward ratio, for every 1 unit of risk you take, you get 2.5 back. And that is really the key, because we can hold 100% cash during a bearish period, and that allows us to perform better than S&P 500. Now, when you compare this to the top 50 hedge funds, you might be asking, hey, why don't I just invest in the top 50 hedge funds? The return net of fees is 15%. So it's not significantly better than S&P 500. And it's really because they charge a very high performance fee. And then for the Sharpe ratio is 1.75. So that is actually lower than S&P 500 and also lower than AI as well. So previously I showed you the final structure with a Canadian fund and a US fund. So we haven't built that out yet. So right now, our current structure is to have a US fund giving the US investors a 20% dividend, and then it will own the shares of the Investing Accelerator parent company as well. The parent company here will distribute to the fund and then distribute to the retirement accounts. For this investment opportunity, you get paid 20% without performance fee. And this will work for US retirement accounts, Canadian retirement accounts, and this is a net return, meaning we have deducted all the fees already. Now, just to give you a reference point, S&P 500 is 13%, QQQ is 14%, and the top 50 hedge funds is actually 15%. And the reason why this number seems kind of low compared to S&P 500 is mainly because they charge a very large performance fee first, whereas for Investing Accelerator, we focus on giving you a predictable and fixed return without that performance fee. So I'll show you the calculation in the coming slide. So you save 86% in fees with Investing Accelerator. So typical hedge fund charges 2% management fee plus 20% performance fee. Compare that to us. We only charge a 0.5% management fee with a fixed distribution. So let me walk you through this table. So let's say both the hedge fund and Investing Accelerator AI makes 21. Now for the hedge fund, the management fee is 2%, and for Investing Accelerator is 0.5, and the performance fee is 20%. So then the total fee here, after you do the math, is 5.8% of your portfolio. And then for Investing Accelerator, it's only 0.5. So then the net return, you end up getting 15, and for us, it's 20. Now, when it comes to max return and volatility, it is possible to get unlimited return for hedge fund, and it is volatile as well. Whereas for Investing Accelerator, it's fixed at 20.5%, and then you get paid out every single month. So it's 1.67% as long as we meet our target. And for hedge funds, there's no monthly distribution, and usually the investment horizon is very long. And for Investing Accelerator, we pay out dividend every month. And if you want to reinvest, there's also that option. And when it comes to hedge funds, usually your money is stuck with it for 5 years. And for Investing Accelerator, we want to keep this lockup period short, so only 2 years in case you want your money back and rebalance your portfolio. And eventually, we want to be able to allow you to redeem it on demand. So that means just like a mutual fund, if you want to exit tomorrow, you can click a button and exit tomorrow. So that is our goal, which we're working towards. So let me just walk you through some numbers on what it is like for tax-free compounding for retirement accounts. And if you choose to reinvest the dividends, it will allow you to double every 3.5 years as long as we're hitting the 20% net distribution target. So for example, you invest 200K, that means you get 40,000 a year for distribution, so 20%. And that is a 3.3K distribution per month. So if you're close to retirement, you can get that as an income or have that as an income boost. If you want to reinvest because you don't need the money yet, then we can automatically buy back more units, and those units will also get you 20%. So then you can double the portfolio in 3.5 years. So this will work quite well for RSP, TFSA accounts in Canada, and for US, it will also work for self-directed IRA accounts as well. So here are the 3 major investment options, and it depends on where you are and your status. So if you're accredited in US or Canada, that means you have 1 million net worth or 200K in income, then you can do the first 2 options. And once we build the mutual fund, then for RSP and TFSA account, there's no status restriction anymore. So for US investor, you can invest directly in the private fund. That is the first option, which gets you 20% per year, monthly distribution, but there's a limit of 100 investors. So then the minimum investment is 200,000 and redeemable 2 years after lockup. So for example, you can use Charles Schwab to hold the private fund, which then gets you the monthly distribution. Now for the cash account in US and Canada, you can directly invest in the parent company, which is based in Hong Kong. So you own shares of the parent company, and you get a slightly higher dividend, which is 20.5% because there's no management fee at the fund level. And the IPO is in 7 years. That's our target. So for the fund option, you don't get the IPO, which is like a bonus payout. when we go public, but for the direct investment in the parent company, you will. So you still get the same monthly distribution in terms of dividend, and then there's unlimited investors here as long as you are accredited. So a 2-year lockup period for now, and then the minimum investment is $100,000. Now the third one is when we set up the mutual fund for Canada, RRSP, and TFSA. So at that point, anyone can invest, and the target is still 20% a year. Monthly distribution, unlimited in terms of the number of investors, and you can exit on demand. So that means, let's say we're doing purchases and redemptions every 2 weeks, then you will be able to just exit 2 weeks whenever we're doing the accounting and closing the books. And the minimum investment there is $50,000. So it should work with any major banks. The broker we're using right now is National Bank, but I think you should be able to buy it with TD or RBC. So today, you can invest directly in the Hong Kong company if you have a cash account and get the 20% dividend. So here is the projected financials for the company. And there's mainly the tuition revenue that I talked about, the hedge fund income, and also investment gain and loss when we're using the investing strategy. 20% of the capital will be used to expand the financial education program, and 80% will be used for the hedge fund. So a little bit about my background. I'm a chartered professional accountant. I'm a chartered investment manager. My co-founder, Michael, is also a chartered investment manager. I used to teach accounting, finance, and also created teaching materials for the Masters of Accounting class. And I also taught data science and machine learning to hundreds of KPMG employees. I was an auditor for Canadian mutual funds, hedge funds, and I was also an M&A advisor for private equity funds in China. And I also helped KPMG build the data science and machine learning team. So far, we raised $1 million. So $500,000 was directly into the parent company, and $500,000 it's in a managed account using the AI strategy. So now our target is to raise $50 million at $20 a share into the parent company, and early investors will get 20% in dividend. So that is really our goal. And then the next round, we want to raise $200 million, and this can be in a combination of the fund or directly in the parent company. And then the next round, $2 billion, and then $10 billion. So that is our long-term capital raising plan. So if you're interested in being part of this mission, you can schedule a call with me, and I'll send you the investor package in terms of the agreements to sign. And then you'll get your first dividend in 90 days once you subscribe. So you can click on the button below and you can schedule a call with me. I look forward to hearing from you and have a chat.